I mean, you have to realize the market's up 8.4% in the last 13 trading days. You look at the internal technical indicators, things like RSI and stochastics, they're up in the 90% range. They're not going to 100%, by the way. You look at 8 of 11 S&P GIG sectors, the percentage of stocks above their 10-day moving average are 80% or better. Those are all extreme readings. And, so you typically get a situation where the market needs to cool off just a little bit. You look at the valuation, we're getting close to 17 times next 12 months earnings. That's where we peaked in the last 5 years, at least for short-term periods. That's where we peaked last September, as a matter of fact. So you've got that. The market got its good news. The Fed did everything but cut yesterday. The news on the G20's gotten better on trade. And although the backdrop of this market is fantastic, you look at the technical indicators, they're good. You look at your breakout to a new high, that's fabulous. But for the very short term, markets just don't move in straight lines. So we need to consolidate this move, and that's probably coming here pretty soon. I think the market will get a little cautious as we come into the G20 meeting, because no one really knows what's going to happen in that meeting and what will come out of it. We think that we'll probably get some okay news. We're not going to get a deal or anything like that. But the sum is the market's in good shape. But for the short term, I mean, we've made our move. We need to sort of cool off a little bit.
I mean, the other thing is the Fed, Mike. I get that the Fed gave a pretty strong signal yesterday that they're looking at cutting interest rates. But the market at this point is pricing in 100% chance of July and more than a 50% chance that this is a 50 basis point cut. That's sort of double what you might normally see. Is the market getting too aggressive with the expectations for the Fed?
Maybe, maybe not. I mean, the market's been doing that. The market's sort of pushing the Fed in that direction. And as far as the Fed's concerned, they probably have room. They may have gone too far last fall. You've got inflation, PCI is under control. We got manufacturing here in the U.S., and it's slipping. If you look at the trends there, they're slipping. If you look at the economic data we've had recently, it's okay. The services side is great, which is fine. The consumer's okay. Jobs are still great. But there is enough room for them to do that. And I think that they're probably going to take their cue from the markets and may get that insurance cut that the market's been hoping for. As far as the timing goes, I'm not quite sure. They have told us they're going to be data dependent. So a lot of it will depend on what comes out of the G20 meeting. Is it positive? Is it a big negative? We'll probably do it. We've got economic data that we'll have to follow on a monthly basis and a weekly basis that'll influence their opinion. So the market may be ahead of themselves as far as the timing goes, but I think the market's going to get their cuts.